What if I told you that most millionaires don't make their money by finding the next hot stock, buying cryptocurrency at the perfect time, or taking huge financial risks? In fact, many self-made millionaires follow surprisingly simple investment strategies that almost anyone can copy. The difference isn't secret information, it isn't luck, and it definitely isn't timing the market. The real difference is how they think about money. While most people focus on making more income, millionaires focus on making their money work harder than they do. They understand that every dollar has a job, and if that dollar isn't growing, it's losing value because of inflation. That's why the wealthiest investors spend less time chasing trends and more time building systems that create long-term wealth. In this video, we're going to break down exactly how millionaires invest their money, where they put their wealth, why they avoid certain investments, and how you can apply the same principles, even if you're starting with just a few $100s. By the end of this video, you'll understand why some people stay wealthy for decades, while others earn high incomes, but never build lasting wealth. Let's get started. The first thing that surprises most people is that millionaires don't keep all of their money in cash. Many people assume that becoming a millionaire means having $1 million sitting in a bank account. That's almost never true. Cash loses purchasing power over time because of inflation. Even if your savings account earns interest, inflation often reduces its real value. Millionaires know this. They keep enough cash for emergencies and opportunities, but the majority of their wealth is invested in assets that have the potential to grow over time. Money sitting idle earns very little. Money invested wisely can grow for decades. This shift in thinking changes everything. Instead of asking, "How much money do I have?" millionaires ask, "How many assets are working for me right now?" That question separates wealth builders from paycheck earners. The second strategy is investing heavily in the stock market. This isn't as exciting as social media makes investing look. Most millionaires aren't day traders. They're not glued to stock charts every minute. Instead, they own shares of successful businesses and hold them for years. When companies grow, shareholders benefit. Over long periods, the U.S. stock market has historically rewarded patient investors far more consistently than those trying to jump in and out based on short-term news. Millionaires understand that time in the market is generally more valuable than trying to perfectly time the market. Instead of chasing yesterday's winners, they focus on businesses with strong fundamentals, consistent earnings, competitive advantages, and long-term growth potential. Some buy individual companies. Many prefer broad market investments because they reduce risk while still participating in overall economic growth. Their mindset is simple. Own productive assets. Be patient. Let compounding do the heavy lifting. The third strategy is one of the biggest secrets behind long-term wealth: index funds and ETFs. Many people expect millionaires to have complicated investment portfolios managed with constant buying and selling. But countless wealthy investors keep a significant portion of their investments in low-cost index funds. Why? Because index funds own hundreds or even thousands of companies in one investment. Instead of betting everything on one business, they spread risk across the entire market. This diversification helps reduce the impact of any single company performing poorly. It also keeps investment costs low. Fees may seem small, but over decades, high fees can quietly eat away thousands of dollars in investment returns. Millionaires understand that keeping more of their returns is just as important as earning higher returns. That's why low-cost investing has become one of the most powerful wealth-building strategies available today. The fourth strategy is something many beginners underestimate: reinvesting gains. When investments generate dividends or profits, many people spend the money. Millionaires often do the opposite. They reinvest those earnings. Imagine a snowball rolling down a hill. At first, it grows slowly. Then it becomes larger. As it grows, it collects even more snow. Eventually, its growth accelerates dramatically. That's exactly how compound growth works. Investment returns begin earning their own returns. Over years and decades, this creates exponential growth. This is why starting early matters so much. Even small investments made consistently can become surprisingly large over long periods because compounding never stops working. Millionaires aren't obsessed with getting rich next year. They're obsessed with building wealth that continues growing for decades. That patience gives compounding enough time to create extraordinary results. And here's something worth remembering. Building wealth isn't about making one perfect investment. It's about making hundreds of smart financial decisions consistently over many years. That's the mindset that separates lasting wealth from temporary success. Now that we've covered why millionaires avoid holding too much cash, invest in the stock market, use index funds, and rely on compound growth, let's look at the next strategies that help them build and protect long-term wealth. The fifth strategy is investing in real estate. For many millionaires, real estate isn't just about owning a beautiful home. In fact, a primary residence is often viewed as a lifestyle purchase rather than an investment. Instead, they focus on properties that generate income. Rental homes, apartment buildings, commercial properties, and real estate investment trusts, commonly known as REITs, can provide regular cash flow while also having the potential to increase in value over time. A quality rental property can produce monthly income, benefit from long-term appreciation, and offer certain tax advantages depending on individual circumstances and local laws. This creates multiple ways to build wealth from a single asset. The sixth strategy is diversification. One of the biggest mistakes new investors make is putting too much money into one stock, one industry, or one asset. Millionaires rarely make that mistake. Their portfolios are spread across different asset classes. They may own U.S. stocks, international stocks, bonds, real estate, cash reserves, and sometimes private investments. If one part of the portfolio has a difficult year, another part may help reduce the overall impact. Diversification doesn't eliminate risk, but it can reduce the damage caused by unexpected market events. Successful investors understand that protecting wealth is just as important as growing it. The seventh strategy is investing in themselves. This is one investment that often delivers the highest return. Many millionaires spend thousands of dollars every year on books, courses, certifications, business coaching, leadership training, and professional development. Why? Because increasing your knowledge and skills can increase your earning potential for years to come. Learning how to negotiate a higher salary, build a business, understand financial statements, or develop valuable technical skills can produce returns that far exceed most financial investments. Your greatest asset isn't your portfolio. It's your ability to create value. The eighth strategy is thinking long-term instead of reacting to headlines. Financial news is designed to capture attention. Every day, there are predictions about market crashes, recessions, inflation, interest rates, and breaking economic events. Many investors panic. Millionaires usually don't. They understand that markets naturally rise and fall. Short-term volatility is normal. Historically, the U.S. economy has experienced recessions, corrections, and bear markets. Yet diversified long-term investors have often benefited from staying invested instead of making emotional decisions. Rather than asking, "What will happen next week?" they ask, "Where could this investment be 10 or 20 years from now?" That shift in perspective changes every decision they make. The ninth strategy is using tax-efficient investing. Growing wealth isn't only about earning higher returns, it's also about keeping more of what you earn. Millionaires pay close attention to taxes. They often make use of tax-advantaged accounts, such as retirement accounts when eligible, hold investments for the long term to potentially qualify for favorable tax treatment where applicable, and work with qualified tax professionals to build efficient strategies. Every dollar saved in unnecessary taxes is another dollar that can stay invested and continue compounding. This doesn't mean avoiding taxes illegally. It means understanding the rules and planning ahead. That's one of the biggest differences between average investors and experienced wealth builders. Finally, millionaires understand one simple truth. Wealth is rarely created overnight. It's built through discipline, consistency, patience, and smart decision-making repeated over many years. Most people underestimate what they can achieve in 20 years because they're too focused on what can happen in the next 20 days. That's why the wealthy don't chase every trend. They build systems that continue working even when they're sleeping. Now that you understand where millionaires invest their money, it's just as important to understand what they avoid. In many cases, building wealth isn't about making more brilliant decisions. It's about making fewer costly mistakes. One of the biggest mistakes average investors make is trying to get rich quickly. Every year, a new investment trend promises overnight success. It could be a hot stock, a meme stock, a cryptocurrency, or the latest social media investing craze. While some people make money, many others buy after prices have already surged and end up selling during a panic when prices fall. Millionaires rarely build wealth this way. Instead of chasing excitement, they focus on consistency. They know that a portfolio growing steadily for decades is far more powerful than a few lucky trades. Another mistake is investing based on emotions. Fear and greed are two of the biggest enemies of successful investing. When markets fall, many investors panic and sell. When markets rise rapidly, many investors become overly confident and buy without proper research. Millionaires understand that market fluctuations are normal. Rather than reacting emotionally, they rely on a long-term investment plan. This discipline helps them avoid buying high and selling low, the exact opposite of what successful investing requires. Another habit that separates wealthy investors is regular investing. They don't wait for the perfect time to invest because they know no one can consistently predict market movements. Instead, many use a strategy called dollar-cost averaging. This means investing a fixed amount of money at regular intervals, regardless of whether the market is up or down. When prices are lower, the same amount of money buys more shares. When prices are higher, it buys fewer shares. Over time, this approach can reduce the impact of short-term market volatility while building the habit of consistent investing. Millionaires also pay close attention to risk management. They understand that every investment carries some level of risk, but unnecessary risk should be avoided. Instead of putting everything into one company or one industry, they build diversified portfolios that can better withstand economic uncertainty. Some investments may grow rapidly. Others may provide stability during difficult markets. The goal isn't to eliminate risk completely. The goal is to avoid risks that could permanently damage long-term wealth. Another important principle is reviewing investments without constantly changing them. Millionaires don't ignore their portfolios, but they also don't check them every hour. Instead, they periodically review their investments to ensure they still align with their long-term goals. If one asset grows much faster than the others, they may rebalance their portfolio by adjusting their allocations to maintain their desired level of risk. This keeps the portfolio aligned with their financial strategy, rather than allowing emotions to take control. One of the most famous investing philosophies comes from Warren Buffett. He has often emphasized that successful investing is not about being the smartest person in the room. It's about having patience, discipline, and the ability to think independently. He has also consistently highlighted the importance of investing in quality businesses, understanding what you own, and allowing time for compounding to work. These principles have remained remarkably consistent throughout his investing career. If you're wondering where to start, the process doesn't have to be complicated. Begin by creating an emergency fund so unexpected expenses don't force you to sell investments at the wrong time. Pay down high-interest debt whenever possible, since guaranteed savings on interest can be just as valuable as investment returns. Take advantage of retirement accounts available to you if you're eligible. Invest consistently using diversified, low-cost funds if they fit your financial goals and risk tolerance. Increase your investment contributions as your income grows. And most importantly, stay invested through market ups and downs instead of making decisions based on short-term headlines. Remember, building wealth is usually not about one life-changing investment. It's about thousands of smart financial decisions made consistently over many years. Every successful investor started somewhere. Some began with just a few dollars. What mattered wasn't the size of their first investment. It was their commitment to keep investing, keep learning, and keep thinking long-term. The good news is that you don't need to earn millions before you begin investing. In many cases, investing consistently with whatever amount you can comfortably afford may be more important than waiting for the perfect moment. Time is one of the greatest advantages an investor can have. The earlier you start, the more opportunity compounding has to work in your favor. So instead of asking, "How can I get rich fast?" ask a better question. How can I build wealth that lasts for decades? That's the question millionaires ask, and over time, their actions provide the answer. If you found this video valuable, consider giving it a thumbs up and subscribing for more practical investing and personal finance content designed to help you make smarter financial decisions. Share this video with someone who's serious about building long-term wealth and let us know in the comments. Which millionaire investing habit are you going to apply first? Thanks for watching, and we'll see you in the next video.